Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dynatrace Inc. quarterly report. Dynatrace Inc. offers a wide range of businesses and services to its customers across various industries. The company's primary business is the development and marketing of its AI-powered observability platform, Dynatrace. This platform provides solutions for infrastructure, application, threat, and AI observability, as well as digital experience, log analytics, application security, software delivery, and business analytics. The company's services include implementation, consulting, and training to help organizations optimize their cloud and IT operations, accelerate secure software delivery, and improve digital performance. Dynatrace markets its products through a combination of direct sales teams and partnerships with global system integrators, GSIs, cloud providers, resellers, and technology alliance partners. The company serves customers in various industries, including banking, financial services, government, insurance, retail and wholesale, transportation, and software. By providing a comprehensive observability platform and supporting services, Dynatrace helps its customers navigate the complexity of modern digital ecosystems and achieve their business goals. The significant drop in Dynatrace Inc. DT stock price by over -41.06% in the past year can be attributed to several key events and broader market trends. One major factor was the broad software sector sell-off and concerns about artificial intelligence, which led institutional investors to shift away from traditional SaaS providers towards companies with integrated AI capabilities. Dynatrace's consumption-driven annual recurring revenue ARR growth model also raised anxieties among investors, contributing to the stock's decline. The broader tech sector volatility further exacerbated the situation, causing instability and fluctuations in the market. Analyst downgrades and price target revisions from prominent firms such as Rosenblatt, TD Cowen, and BMO Capital also played a significant role in the stock's drop. These downgrades were largely driven by concerns over macroeconomic spending within the enterprise software industry and competitive pressures from hyperscalers and open-source alternatives. The negative market response to Dynatrace's Perform 2026 user conference was another major contributor to the stock's decline, with investors expressing concerns over extended sales cycles for large observability deals. Additionally, Dynatrace consistently underperformed both the broader market and its industry peers within the technology sector throughout the year. However, despite these challenges, Dynatrace's stock experienced a brief climb in early February 2026 after reporting strong Q3 fiscal 2026 results that surpassed guidance and raised full-year targets. The announcement of a new $1 billion share repurchase program also provided some relief to investors. Dynatrace Inc. market capitalization of $11 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Dynatrace Inc. holds a significant advantage in their industry. Dynatrace Inc. trades at a higher price-to-earnings ratio of 60 times and a higher price-to-book ratio of 3.94 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 37% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted, encompassing both internal and external factors. On one hand, customer purchasing decisions, market acceptance, product offerings, marketing and sales efforts, and economic factors play a significant role in determining a company's revenue trajectory. These common drivers can either propel revenue growth or hinder it, depending on how effectively a business responds to changes in the market. Industry-specific drivers also come into play, with cloud-based solutions, regulatory changes, tax matters, and government demand being key considerations for certain sectors. External factors such as geopolitical tensions, climate change, and catastrophic events can have far-reaching consequences for businesses, impacting revenue growth or decline in unpredictable ways. Internal factors including talent acquisition and retention, share repurchase programs, and dividend payments also contribute to a company's revenue dynamics. By understanding these various drivers, businesses can develop targeted strategies to mitigate risks and capitalize on opportunities, ultimately influencing their revenue growth or decline. The net income and profit margins of the company have undergone significant changes over the past quarter and year. In terms of net income, it has decreased by $321,697, 89%, in the past quarter, and by $299,127, 67%, in the past year. This decline can be attributed to several factors, including the issuance of common stock related to employee stock purchase plans and the exercise of stock options, which contributed to a decrease in net income. The profit margins have also undergone changes. The gross profit margin has remained stable at 81%, but the operating profit margin has decreased from 21.1% to 14%. This decline can be attributed to an increase in operating expenses as a percentage of revenue, from 60% to 64%. Additionally, the net income margin has decreased significantly, from 85.5% to 9.8%. The reasons for these changes are multifaceted. The issuance of common stock and the exercise of stock options have had a negative impact on net income. Furthermore, a decrease in deferred income taxes by $378,795 may indicate changes in tax laws or accounting methods. Additionally, an increase in share-based compensation by 13% may also be contributing to increased costs. Overall, the company's financial performance has been impacted by various factors, leading to decreases in net income and profit margins. It is essential for management to address these issues and implement strategies to improve profitability and revenue growth. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from various pages shows that the net cash provided by operating activities has been steadily increasing over the years. For instance, in 2025, the net cash provided by operating activities was $335,489, which is an improvement from the previous year's figure of $296,629. Additionally, the free cash flow for 2025 stands at a significant $317,080,000, further indicating a strong financial position. The company's ability to generate positive operating cash flow over different periods, including 3 months and 9 months in 2025, suggests a stable and consistent performance. This trend is also observed in 2024, where the net cash provided by operating activities was $335,489,000. Overall, these figures demonstrate that the company is generating sufficient operating cash flow to support its business operations. The company's debt levels and interest expenses have undergone some changes over the past year. Initially, the total debt decreased from $1,518,530 to $1,351,581, indicating a reduction in debt. However, it is worth noting that long-term debt was not outstanding under the credit facility as of December 31, 2025 and March 31, 2025. In terms of interest expenses, there has been a slight decrease from $575 in 2024 to $572 in 2025. Additionally, for the 3 months ended December 31, 2025, interest expenses decreased slightly from $12 million to $12.3 million compared to 2024. Despite these changes, it is stated that there are no significant changes in total debt levels, and debt level remains unchanged. Overall, while there have been some minor fluctuations in debt levels and interest expenses, the company's financial situation appears relatively stable with no significant changes noted. The performance of various segments and regions has been a mixed bag for the company. On the positive side, North America and Europe, Middle East, and Africa have shown significant growth in revenue. In North America, revenue increased by 15% to $257,824 over 3 months, and by 17% to $752,597 over 9 months. Similarly, Europe, Middle East, and Africa saw a 22% increase in revenue to $165,970 over 3 months, and a 21% increase to $477,028 over 9 months. However, not all regions have fared as well. Asia-Pacific has been a major disappointment, with revenue decreasing by 22% to $50,199 over 3 months, and by 18% to $141,454 over 9 months. Latin America's growth of only 8% to $41,480 over 3 months and 19% to $115,592 over 9 months is also underwhelming compared to other regions. The company has faced significant challenges in international markets due to restricted trade, sanctions, and changes in laws and regulations. Additionally, countries with increasing restrictions on trade have been negatively impacted by the geopolitical landscape and national security concerns. These factors have contributed to poor performance in these areas. Management is optimistic about the company's outlook, emphasizing the need to drive innovation to meet customers' needs and grow customer relationships. The overall strategy involves investing in future growth opportunities that will drive long-term value, leveraging a global partner ecosystem, optimizing costs, and improving efficiency and profitability. Key focus areas include expanding the functionality of the Dynatrace platform, evolving AI capabilities to drive differentiation, and growing the customer base through investments in go-to-market strategies. The company believes it has a significant market opportunity based on its technical differentiation and ability to integrate into customers' cloud ecosystems. Financial projections indicate that the company expects to recognize 53% of remaining performance obligations as revenue over the next 12 months. However, management also acknowledges potential challenges such as market acceptance issues, changes in renewal rates, and increased costs associated with customer growth. Despite these challenges, the overall outlook remains positive, driven by a strong focus on innovation and customer relationships. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has engaged in intra-entity asset transfers, which involve the transfer of intellectual property within the entity itself. Additionally, it has acquired complementary companies, products, or technologies that align with its business goals. On the other hand, the company has also made strategic decisions to divest certain operations. One notable example is the suspension of operations in Russia and Belarus in 2022. This move suggests a deliberate effort to reevaluate and adjust its global presence in response to changing circumstances. The company's financial activities have been notable in recent years. One key aspect is its decision not to pay dividends to shareholders. This means that instead of distributing a portion of the company's profits as dividends, it has chosen to retain those funds for other uses. In terms of share buybacks, the company has implemented 2 separate programs. The first program, which was completed, allowed for up to $500 million in share purchases. A second ongoing program, announced on February 9, 2026, enables the company to buy back shares worth up to $1 billion. These initiatives demonstrate the company's focus on returning value to its shareholders through alternative means. There are valid concerns about inventory buildup and supply chain disruption. The potential risks from tariffs and tax changes could lead to increased effective prices and harm revenue, as mentioned on page 60. Additionally, vendor or supplier breaches affecting operations or financial systems pose a significant threat, as noted on page 64. Furthermore, the possibility of catastrophic events such as natural disasters, pandemics, and climate change-related disruptions also looms large, with potential impacts on infrastructure and supply chains highlighted on page 78. These concerns underscore the need for companies to be proactive in mitigating these risks and ensuring business continuity. That concludes the financial summary for Dynatrace Inc. Feel free to comment below, and I will be happy to answer them when possible.